As a final point of discussion, I'd like to take the opportunity to talk a little bit about modern debt markets, which of course includes our modern government bond markets, as well as corporate bond markets, and some of the interesting evolution which has occurred with the rise of computers in the last few decades. To begin with, it's worth talking about how traded debt is structured in the modern world. For the most part, debts that have a maturity or are due in less than 12 months are what we call short-term promissory notes, sometimes referred to as money market instruments. As such, because they're due in less than 1 year, these instruments are sold at a discount from their face value, meaning that I borrow $80 and I promise to pay back 90. There's no intermediate interest rates, but the $10 spread divided by the $80 I originally was lent gives you some idea of what the underlying or implied interest rate is for these kinds of securities. When you're dealing with longer term debts, what we otherwise refer to as bonds, these are usually sold at their face value, meaning I borrow $1,000 and I repay you $1,000. But along the way, there are intermediating interest payments that I make generally on a semi-annual basis. Now, these interest payments are referred to as coupon payments. And this is a bit of an old carryover from the 19th century, but the reason that we refer to them as coupons is because historically speaking, debt contracts, which were physical securities at the time, had perforation along the edge that allowed you to detach part of the security, effectively a coupon, that was numbered, that you could mail in to the issuer. That way they would know who exactly to pay the interest to. So if you notice in a number of classic crime movies, everything from The Great Gatsby onward, that the criminals are always interested in being paid in bearer bonds, this is why. Because they allow for the anonymous collection of interest by simply being the physical bearer of the security. Now finally, we also have some bonds which are effectively perpetual. They will make regular interest payments forever, but they will never return the borrowed principal to you. An example of this would be the Dutch Lijk Bovendams. My Dutch is terrible, so apologies to anyone who happens to speak Dutch properly, which were perpetual bonds that were issued in 1648 to help sustain and pay for national waterworks. The Netherlands is a traditionally very low country. Much of their current land mass is actually below sea level, and so sustaining waterworks to prevent flooding from rivers flowing down from the Alps has been an essential part of their national development. It's worth noting that Yale University actually retains one of these 370-year-old bonds and flew over in 2015 to collect the back interest which was due to them. Now, in terms of modern bond markets, if we take a look today, the size of international borrowing at interest in a bond market is enormous. We're talking about a market of approximately $130 trillion. Of that total amount, roughly 1/3 of this is corporate, and the other 2/3 are government and their agencies, including organizations like Fannie Mae or in the United States or CMHC in Canada that repackage mortgage obligations and sell them off as securitized bonds. Now, modern bonds usually come with very specific terms attached to them. A bond is a legal contract, and so stipulating all of the different kinds of conditions that go with that obligation is fairly important. These would include things like the seniority of the lender, any collateral that has been pledged to that particular loan, any covenants that might trigger a default aside from simply non-payment, or even embedded options that would allow either the borrower or the lender to unilaterally make changes to the structure of the underlying contract in ways that were previously agreed upon when they were issued. So as you can imagine, with all of these different kinds of specialty aspects to it, this is a market that necessarily screams for specialist providers to help investors navigate. Most bond indentures, or the contract that underlies the loan, ranges from 200 to 300 pages and involves a lot of complex terminology that the average retiree is simply not capable of making heads or tails of. And therefore, most investments that households make into bonds are channeled through financial intermediaries like pension funds, insurance companies, or even bond market mutual funds. But these institutions, in turn, because there are thousands of different bonds being issued by thousands of different issuers, they themselves ultimately turn to different kinds of specialists to subdivide the various tasks associated with reviewing the quality of a loan application. And so the three major groups that you'll recognize as being participants in these modern markets are investment banks, that help to reduce both search and contracting costs, rating agencies that help to reduce the cost of risk assessments, and trustees that help to verify that covenants have not been broken, thereby reducing our overall monitoring costs. So these types of specialists focus on very particular aspects of the lending decision. And you can get a sense of how specialized our debt markets have become compared to traditionally when we see the subdivision of these three tasks into different specialist firms where banks or other lenders may have traditionally internalized all of these processes. Another big change we come across in the modern world is the introduction of computers, of course, which has a dramatic effect on the cost of administration, issuance, and monitoring for all of these different kinds of loans, whether they're at the wholesale or the retail level. The big impact here has been a reduction in the minimum bite size that banks are willing to make as loans. Previously, banks would need to lend out a few $1,000s to be able to accrue a bit of a margin spread on that $1,000 to cover their costs of loan administration. If they're not able to cover the costs of loan administration with the interest rate spread, it doesn't make sense for them to lend out the money, even if it was going to come back with 100% certainty. So of course, this meant that only relatively large loans ever got made, leading to the adage that lenders cared about rich people, but not poor people. It's interesting to note that with the advent of computers, that cost of administration has declined sufficiently that we can now make relatively smaller consumer-based loans in an efficient manner. Now, computers have also created for us a vast amount of non-payments data via mobile networks, social media, and a variety of other sources, which can be used to inform credit decisions. Remember that back in the 70s, there were a few laws that were passed to protect consumers against having certain kinds of data, like ethnicity or religion, being used in credit decisions. On the other hand, there are an enormous amount of data points which we see being generated, which could have correlation with defaults. And there's a lot of fintechs who are working on this space in particular. To give a simple example of one that was used several years ago by a Canadian fintech, how often your phone battery goes dead. The general correlation was that people who allowed their phones to go dead and did not monitor the level of their battery life also happened to be the kinds of people that would let their phone bill slip past due or would pay their rent a few days late. And therefore, lenders found that it was valuable information to simply know how often your phone battery died and to use that information to inform their credit decisions. Even further down the rabbit hole, mobile devices and fast internet have now made it easy for even small amounts of savings, dollars and cents, in fact, in some cases, to make their way back into circulation. Any kind of idle cash that sits in apps like market trading apps like Robinhood necessarily finds its way into money market accounts, even if the users of that app haven't put it there themselves. The idea of Robinhood was that it was a free discount broker that would allow access to stock markets at no transaction cost. A lot of people wondered how Robinhood would make money, and it turns out what Robinhood is doing is borrowing all of the idle cash from its investors and lending it out at interest and keeping the interest for themselves, and using this as the profits from this to subsidize, of course, the trading costs associated with their business. But what's important here is not so much that Robinhood has found a clever way to finance themselves, so much as the idea that idle savings, which would otherwise sit in our wallets, are making their way back into markets and meaning that we're taking capital and recirculating it, allowing for more economic activity to occur in a more efficient fashion, as opposed to simply collecting, say, gold coins at my house, which may end up dropping out of circulation entirely and thereby slowing the rate of economic development. But computers have also created some completely new ideas, right? Rather than simply fixing up the back office of lending and making it more efficient for large-scale lenders, we also have the development of peer-to-peer lending platforms in which there is no intermediating banker, for instance, and instead what we have are methods for connecting lenders directly to borrowers. Now, of course, there are no specialists involved in this. There are no ratings agencies, no investment banks, no trustees to monitor conditions. Under peer-to-peer lending, the lender sets their own conditions and their own interest rates, and they negotiate with the borrowers for exactly what these conditions will be. Now, of course, that means that there is no one to pay for search costs, no one to pay for monitoring of loans, no one to pay for risk assessments. And that means, of course, that the spread between cost and revenue increases. This means that there's more profit here because there are fewer people eating the pie. Now, what that equates to in general is slightly lower interest rates for borrowers and slightly higher interest rates for lenders who no longer have to pay another firm to get in the middle and intermediate between them. However, there are, of course, a lot of risks associated with this. How competent are you at assessing the risk of a consumer loan compared to a bank that may have assessed thousands of such loans? Nonetheless, these types of platforms do exist and provide an opportunity for us to continue to recirculate capital in a non-intermediated fashion, which increases the velocity of money overall, makes capital more widely available, and of course can encourage more economic activity. Now, as a final note on evolutions of debt under computers, one of the interesting ones, perhaps for you as students, is the notion of peer-to-peer student loans. As opposed to simply looking at a peer-to-peer mortgage or peer-to-peer consumer loans, one of the interesting areas where we've seen a significant rise in peer-to-peer lending was in financing the education of people who are believed to be highly successful. Some of the early student loan or peer-to-peer student loan companies like social finance boast terribly low loss rates, fantastically low, in the range of fractions of a percent on the total of $22 billion that they've lent out over the prior decade. And it raises a lot of questions as to how they could possibly be so successful. But it's worth noting, of course, that social finance basically is a technique for Ivy League business school graduates to finance other Ivy League business school students. So in that sense, you have some idea about not only what the career path of people will be, you know the quality of the education they'll receive, and in fact, you may even be willing to hire these people in order to ensure their future economic success, which you would share in. Now, not all of these are effectively peer-to-peer debt transactions. Some of these are packaged a little bit like loans, or no, sorry, a little bit like equity as opposed to loans, in that there is a measure of profit participation that takes place. In some of these organizations that we find actually are making these peer-to-peer student loans, rather than charging people interest on their loan, a fraction of their future earnings is remitted to their financiers instead. Now, most of these have set some kind of maximum cap. In general, it's at ×5 with one leader that I looked at. But the interest rate and the maximum repayment that students have is negotiated directly between the lender and the borrower. One of the big advantages of these types of loans is that it creates an incentive for the lender to try to ensure that the borrower succeeds. And that's why student loan financing has been so particularly successful. Because if we've got people who are financing, say, law students at Harvard, who are already graduates of Harvard Law, then they have a pretty good idea about the future success of these students and find themselves in a position to ensure their success and ensure their ultimate repayment. So there's a lot of evolution that's still happening in the debt space, and computers are playing a very significant role in reshaping exactly how these markets are going to work in the future. I suspect that over the next 20 or 30 years, we'll see significant further improvements in this space, and I hope it's you who will be able to contribute to this.